Are assumable mortgages the thing that's going to fix this real estate market? I'm Realtor Nick Belmore. We're going to take a look today and react to a video from CNBC. And one of the things that they're talking about today is assumable mortgages. And not sure out there they're going to talk about it in the video, but for those of you out there who might not be sure what I'm talking about, assumable mortgages are typically our government-backed mortgages. And what it does is it allows a new buyer to take over the existing mortgages. Because we know one of the toughest things to deal with today is the cost of buying a new home. No doubt it's one of the biggest impacts. If you're one of the younger people watching this, if you're in your early, mid, late 20s and you're thinking about buying a home, it's probably one of the biggest barriers you're facing as we start to take a look. So here's the question: can assumable mortgages make the difference? Let's take a look and find out.
My wife and I have been looking for a new home for the last 2 years.
This is Vandal. He is a new homeowner who is facing many of the same issues other prospective homebuyers have faced in this hot housing market.
We really just hadn't had much luck, mainly due to increasing interest rates driving up the cost of our mortgage. We did put in a couple of offers that didn't go anywhere just because it's a very hot housing market here.
But the Vandal story is a little different than most homebuyers navigating the market right now.
We found one that popped up. So it was the right size, it was the right area, but we knew it was a little bit out of our budget just because the interest rate was too high. Just happened to look at the Realtor app again, and there was a button on that app that said, "This home has an assumable mortgage."
What the Vandals found is a rare type of mortgage called an assumable mortgage, landing them a 2.6% mortgage rate as opposed to the 2024 average, which sits just above 6%.
An assumable mortgage is a type of home loan where the buyer can actually take over the existing mortgage terms from the seller.
That meant a difference of over $800 a month.
A common occurrence in the 1970s and 80s, assumable mortgages are a rare find in today's real estate market.
So basically what he was looking to do is take over the existing mortgage. Number one, obviously I'm already concerned when a home's out of your price range and you're relying on an assumable mortgage in order to go ahead and make that happen at that stage. If you've seen some of the other videos where we talk about, mortgages and where things are at right now, my stance is definitely not to be maxing out the debt to income ratio when we're in the process of applying for or shopping for a home at that stage. So interesting. Obviously, that's definitely a key in this story, is him being able to go ahead and get that lower rate on, good chunk of the mortgage that they're looking at that stage.
In 2023, only 4,052 Federal Housing Administration mortgages were assumed. That's still a 59% increase in FHA mortgage assumptions since 2021. For Veterans Affairs mortgages, the jump is even larger, with 2,244 mortgage assumptions in 2023, an increase of 713% compared to 2021. And 2024 assumptions are already outpacing previous years for both the VA and FHA.
So again, this is where I want to be ultra clear. You're talking about a little over 10,000 assumable mortgages in 2024. There were 4 million homes sold. 4.1 million is the number it looks like they're reporting right now, sold in 2024. So when we look at 4.1 million sales and we look at 10,000 assumable mortgages that actually went through and were assumed, I think at that stage, it really shows how unrealistic assumable mortgages are for the average person. Do you think that every buyer out there doesn't want to go ahead and have a cheaper payment? Of course they do. But why out of 4 million did only 10,000 of them actually go ahead and have their mortgage assumed when they moved? Obviously, not every one of those 4 million homes that sold in 2024 was assumable, but a giant chunk were, and that's a tiny, tiny number. So clearly there's some barriers that are preventing assumable mortgages from being a regular occurrence in today's market.
So what are assumable mortgages? How do they work, and why aren't they more common?
The vast majority of homeowners don't actually know that they have an assumable mortgage buyers don't know how to find them, and agents don't know how to coordinate the purchase.
Wait a minute. Do we really believe that buyers have no idea? I mean, listen, if you own a home out there right now and you're watching this, do you know whether you have an FHA, VA, conventional, or a U.S. Department of Agriculture or Rural Development loan? I'm willing to bet you do. I think the idea that people have no idea what kind of mortgage is kind of ridiculous. I don't think that's a true statement at all. The idea that lenders don't know how to do it, the people selling the product have no idea that an assumption can happen. Again, I'm not so sure these are the factors that we're really talking about that are holding back assumable mortgages.
Public interest in them is climbing. Google searches for the term assumable mortgage have climbed in tandem with increasing mortgage rates over the past 2 years.
This is the most unaffordable time to purchase in America of the last 40 years.
All right, finally something I agree with.
We're priced out for being able to purchase a home.
When it comes to the average U.S. home buying experience, most Americans follow the same process. A buyer approaches a lender to get pre-approved for a mortgage. When the buyer settles on a home, they use their own mortgage to cover the cost at a fixed rate. The home buyer then pays off that mortgage over the term of the loan, normally 15 or 30 years. What an assumable mortgage offers is the option to take over the seller's loan. So instead of taking out your own loan at a new rate, you inherit the remainder of the seller's mortgage at whatever rate they took it out at. So a home buyer that took out an assumable mortgage in 2020 could offer an interested home buyer a sub 3% mortgage rate.
For the homeowner, the value of including their low rate mortgage in their home sale is to maximize their probability of being able to sell the home by expanding the universe of buyers who can afford to purchase it.
In the 1970s and 80s, U.S. interest rates hit record highs, peaking at 18% in 1981. Assumable mortgages were more popular then, but have largely fallen out of public consciousness following the passage of the Garn-St. Germain Act in 1982, allowing private lenders to ask for immediate repayment if a property is sold. This is called a due-on-sale clause.
Again, let me just stop it right there because I'm not so sure the due-on-sale clause is the reason. What's the real reason there wasn't a lot of popularity in assumable mortgages for, I would say even the last 15 years? Because mortgage rates have been low. There hasn't been a point since really the early 2000s where mortgage rates have gone from a low rate to a spiked rate until today. So if you were a buyer, let's just say in 2020, why would you not do an assumable mortgage? Because most people who had assumable mortgages were at a higher rate than a new purchase money mortgage at that time. Who wants to go ahead and assume someone's 5% rate when you can buy a home at a 2.75 at some of those times, or even a 3.25, which was realistically, they were sub 3 for a very, very short time. So when we look at the math, it makes sense why it was out of the public consciousness, because it simply didn't make sense for the people making the purchase. Today, does it make a little bit more sense? It does, but still some barriers to look at.
Mortgages are not really popular at all simply because they're very limited.
Assumable mortgages do come with their own set of hurdles. The possibility of higher than expected down payments, knowledgeable lenders and real estate agents, and the fact that they're only offered through government-backed loans.
Okay, so again, are we pretending that it's the lack of knowledge right now? Because I think the honest answer to this is more number one, more down payment. It's a struggle for most buyers to even get the minimum down payment, let alone to cover the gap between what the old seller took out in a mortgage and the reality of what they want for their home today.
VA, FHA, and United States Department of Agriculture mortgages are now the main type of mortgages able to be assumed in the U.S.
The most popular state in America for assumable mortgages is Texas. This is because there's a large military population there, and also a large first-time home buyer population there.
We are a military community, so there's an Air Force base in our community where there are a lot of VA loans. It's also a younger, college town, so there's a lot of FHA loans within our community.
And government-backed loans mean more paperwork, so if you are looking to enter into an assumable mortgage, get ready to settle in. They can take a while to close.
Assumable mortgages are very complicated and they involve a lot of paperwork, and that's why a lot of lenders simply don't want to do them. Some don't even really understand them.
So there's a lot more detailed information that is required. We were told right up front by the mortgage company that the process is going to take at least 90 days.
Okay, so again, you're the seller. Do you want to wait an extra 90 days for this buyer. If you don't have a lot of activity and the price makes sense and the buyer's a strong buyer, this might not be a negative factor on you as a seller. However, if the prices are the same to you and one buyer is offering the price on a normal purchase money mortgage and they're going to close it in 30 days and the other one's at the same spot, but they need to wait 90 days to assume your mortgage to move forward, it could realistically work against you in that offer process.
Buyers should also be prepared to put down more money than the typical 20% down payment. Assumable mortgages require buyers to cover the money already paid towards the mortgage, as well as any appreciation on the home price.
I think we found the real barrier to why people aren't using assumable mortgages. So you've got to return the down payment above and beyond the assumed mortgage, and you're going to have to cover the appreciation. That could be hundreds of thousands of dollars in a lot of cases.
In really rapid home price appreciation. So somebody who has a home that they had 20% equity in may now have a lot more money in that home than they originally had.
For example, say a homeowner took out a 30-year fixed-rate VA loan for a home at $200,000 and paid off about $25,000 of that over 2 years. The person assuming the mortgage would have to pay the buyer the money they've already invested, that $25,000. Additionally, if that homeowner decides to sell their home for $250,000, the buyer has to cover the additional $50,000 in appreciation, either in cash or by taking out a second mortgage.
A little bit of a guessing game.
Okay, so I'm going to have to agree. This is a little bit of a guessing game. This is a hypothetical scenario. But when we really look at the numbers, first off, most people aren't moving in 2 years after buying their home. Average American is looking at 5 to 7 years when they go ahead and make a move. So let's use the lower number. Let's just say in our area, somebody went ahead and they bought 5 years ago. You're closer to the mid 50 to the mid 60% in the appreciation. So on the same $200,000 home, outside of the original $25,000 down payment in this scenario, you would actually have to go ahead and you would be covering something closer to 120 to 150, meaning cash out of pocket for you on that closing could ultimately be $150,000, $175,000, depending on the appreciation, the sales price, the scenario, all those different factors. That's the barrier, right? It's not about people don't understand how to assume loans. It's about the fact that to save those few percent, your down payment money has to be so substantial, unless you can go ahead and get a mortgage that's ready to take a secondary lien position to the original mortgage that you're assuming. Oh, by the way, if that mortgage is going to be able to cover that and be in a secondary position, the bank is taking on more risk, and therefore they're going to increase the fees and they're going to increase the interest rate to reflect the risk they're taking on. Why is there more risk? Because in the secondary lien position, if the home goes into default, the first lien position gets paid off in full at first, and the second lien position gets what's left over. If those proceeds go ahead and cover the gap, they're fine. But if they don't, they're the ones getting shorted on that payoff in case of default. So of course, what do they do to protect themselves? They charge more money. They charge more money in the fees it takes to get that loan initially, and then they charge more money in the interest rate to protect the risk they're taking on by being in the second lien position. Now, if that percentage rate is so much bigger, it can take away the savings of the assumed rate in the beginning, not counting the amount of money that needs to come out of pocket. 25 years of doing this, a few people do put 175, 150,000 down when they buy a house in that range, but it's rare. Most people are focused on somewhere around that 10 to 15% down payment as they're going through their purchase. So again, huge difference in the numbers. Who does this really affect as we're talking about it? Rich people, for sure. You got that 150K and you can make that move, it's going to save you some interest rate. It's going to definitely be a better deal. But for the most part, first-time home buyers getting into it, this doesn't seem like a real solution to the problems they're facing today.
Because you're negotiating on what the sale price will be of the house, of course. You don't really know up front what is owed on the house either. Got lucky in that respect where what was owed on the house versus what we had settled on for a sale price was almost exactly that same 20% we had saved for our down payment.
So he's even telling you in this example, if they hadn't had a severe lack of equity in the home, this probably wouldn't have been feasible for them as buyers.
Hurdles for getting an assumable mortgage: awareness, not just by buyers, but sellers who don't know to advertise their home as assumable.
So about a fifth of the homes on the market, or 20 to 25% of the homes on the market, will be fully assumable at one time. The number of assumption transactions that are happening is far fewer than the number of mortgages which can be assumed.
Let's also take this into account as well. Over the past 5 years, in a lot of cities, we ran into bidding wars. And one of the things that we saw is a lot of the winners of those bidding wars were simply not doing the government loans. Why? Because the sellers saw them as a disadvantage. If you were doing an FHA versus a conventional at that stage, the seller was not interested in the FHA repairs that might go along with that loan, especially when the competing loan as a conventional didn't have that caveat to the appraisal through part of that process. Same thing on VA. Of course, VA, we saw so many Tidewater appraisals, meaning that the appraiser was telling us right away he wasn't going to even come in at the number of the agreed upon sales price between buyer and seller. These are a lot of factors that led to more conventional loans happening versus some of these assumable loans in the past 5, 6, 7 years, which of course absolutely plays into how much is available for people to assume. And again, that gap, because in the example in this news story, the guy was like a 2-year gap, and so he was able to cover it. If we're talking 9, 7 years, you could be talking about 60, 70% of the home is that open equity area that you're going to have to cover in cash or in a secondary loan position, extra mortgage.
And at times complex, companies like Realm are working to streamline the process for buyers and sellers.
97, 98% of the people who have these loans don't know that it can be a marketing advantage. Because what kind of homeowner sits around thinking about their loan type being the marketing advantage in their home sale?
Other companies like Assumable IO and Assume List can help match interested homebuyers with assumable mortgages.
I think once that word starts getting out, this is a possibility, we're going to see more and more of these pop up.
Yeah, I'm not so sure that's actually going to be the case. As I come back into this, my main reaction and my conclusion from going through this news story, here's the reality. The gap's the problem. It's not how many people know it or how many realtors or loan reps understand it. That's not the issue one tiny bit. The issue is being able to cover that gap, and the industry, when it comes to lending, is not super risk tolerant. They're not excited to give you a secondary loan. Buyers out there, how much money do you have? Most of them don't have those giant amounts to cover the gap between what today's current market value is and the basis of the assumable loan at that stage. Long story short, the answer to me is no. Assumable loans are not actually a solution to fixing some of the problems that we're having in the real estate market now as we go through this process. Hopefully you guys got some value out of this reaction to this video. And if you are wondering yourself, is there assumable loans that could work for me in the area? Or you're thinking, hey, it's time for a change. I'm looking for the right house, the right fit for my family. Reach out to me. My information is in the description below. And one of the things I love to do is help people get into the homes that work for them at this stage in life. I'll see you guys on the next video.